Understanding payments, methods, evolution, and considerations. Payments are a fundamental aspect of economic transactions, representing the transfer of money, goods, or services in exchange for value agreed upon by the involved parties. With the continuous evolution of the financial landscape, the methods and mediums used for payments have diversified significantly, from cash and checks to digital wallets and cryptocurrencies. In this article, we'll explore the complexities of payments, expand upon the different types, and highlight the key considerations involved in the payment process. What is a payment? A payment involves an exchange where one party provides value to another, typically in the form of currency or goods/services, based on mutually agreed terms. The acceptance of payment extinguishes a debt obligation and may involve various mediums, including cash, checks, credit/debit cards, wire transfers, and emerging cryptocurrencies. Key aspects of payments. Timing. Payments can be made before, during, or after the provision of goods or services. This flexibility is evident in scenarios such as advance payments, installment payments, or full pay upon receipt. Currency and legal tender. The mode of payment usually involves a country's legal currency. However, payment can occur in multiple currencies, albeit with additional fees related to foreign exchange. Parties involved. In the U.S., the terms payer refers to the one making the payment, while payee refers to the one receiving it. Types of payments. The evolution of technology has led to various payment methods, each with its unique characteristics, benefits, and challenges. 1. Credit cards. Mechanism allows users to borrow funds up to a set limit to make purchases, with repayment expected later. Pros: build credit history, rewards programs, provides fraud protection. Cons: potential to incur debt, processing fees for merchants, high interest rates on unpaid balances. 2. Debit cards. Mechanism: directly linked to the user's bank account, funds are withdrawn immediately upon transaction. Pros: supports budgeting by limiting spending to available balance, easy for everyday transactions. Cons: limited fraud protection, may incur overdraft fees, does not help build credit history. 3. Cash. Mechanism: physical currency used for transactions without intermediaries. Pros: no transaction fees, straightforward budgeting, anonymity. Cons: risk of loss or theft, no credit building, lack of spending tracking. 4. Mobile payments. Mechanism: utilizes smartphones with near-field communication, NFC, technology to facilitate quick transactions. Pros: quick and secure, offers advanced fraud protections. Cons: not universally accepted, dependent on technology and specific devices. 5. Checks. Mechanism: written instructions to a bank to pay a specified amount from the payer's account. Pros: tangible proof of payment, typically incurs fewer fees. Cons: longer processing times, risks of fraud or bounced checks. 6. Electronic funds transfers, EFT. Mechanism: includes wire transfers and automated clearinghouse, ACH, transfers for quicker electronic payments. Pros: fast, efficient for payroll and larger transfers. Cons: transaction fees can be higher, funds must be readily available. 7. Cryptocurrency. Mechanism: digital tokens that use blockchain technology for secure payments without intermediaries. Pros: instant transfers, no need for a traditional bank account. Cons: volatility in value, requires technical knowledge, less widespread acceptance. Special considerations in payments. Payment terms and discounts. Establishing payment terms is crucial for businesses. It defines when payments are due and if discounts are available for early payments, e.g., January 10th, net 30. Acceptance and refusal of payments. Creditors, while generally required to accept payments, can refuse under specific circumstances, e.g., after banking hours. A payee must acknowledge receipt of payment, typically through a receipt. Installment and advance payments. For more complex agreements, such as real estate contracts, installment payments may be stipulated. Alternatively, advance payments may be required for services yet to be rendered, placing obligations on the payee to deliver on the contract. The future of payments. As technology continues to advance, the future of payments is leaning towards digital and mobile solutions. Consumer preferences for speed, convenience, and security are reshaping how transactions are completed, as more people embrace digital currencies and contactless payments. Conclusion. Payments are an essential and evolving aspect of modern commerce, reflecting changes in technology and consumer expectations. Understanding different payment methods, their advantages, and disadvantages is essential for individuals and businesses alike. As the landscape continues to change, adaptability in the ways we conduct transactions will be necessary to navigate the financial world effectively. Whether through cash, credit, digital wallets, or cryptocurrencies, the fundamental concept of exchanging value remains at the heart of every transaction.